We're sort of searching for a theme in markets today. It feels like everything is in wait-and-see mode right now. Is that right?
Yeah, I think everybody's going to wait and see on the Fed. Nobody really expects a March hike, but June is on the table.
I wonder the degree to which you look at this event, the Fed meeting, as a discrete one when you have so many other central banks meeting this week. Obviously, we had the ECB last week. You've got the Bank of Japan, Bank of England. Do you look at this alone, or is it in concert with all those others?
Yeah, I do. You know, the dollar is really the world's currency, and the Fed's employment and price stability mandate was written in a time before globalization. So if there's one thing we've learned in the last few years, it's that clinging to old beliefs can be fatal, and the Fed's mandates are an anachronism in history. So what we need is an exit that's paced by the global economic recovery so the dollar doesn't strengthen excessively, the bear curve flattening doesn't occur in the treasuries, and spreads don't widen excessively.
And what's the probability of that actually happening? Because we did somewhat optimistically see the dollar weaken last week, even though the ECB did some more easing, which was unusual.
Well, the ECB easing, the really good part of that was the backstop on lending and the cheap funding for lending they provide to peripheral banks. It's essentially a tax on excess liquidity in Northern European banks and a subsidy to Southern European banks that get free money at or around the deposit rate of minus 40 basis points. So getting the credit engine started in Europe is what's key. For China, it's currency stability, GDP stability, and restructuring. And for the Fed, it's simply not being in a hurry just because the U.S. recovered first, as we were first in, first out of global recession.
Let me just circle back to something you said about how anachronistic the dual mandate is in your estimation. Looking at inflation, is it the target that you think is anachronistic? What exactly do you find wrong with the focus?
No, it's just that the U.S. is not in sync with the rest of the world, and now that's not an abnormal condition. That occurs a lot of times in history, but at this junction of history, when global growth is teetering on deflationary spiral, and we could have trade wars, we could have political changes, we've got populism, there's a lot of things going on. This is the wrong time to say, okay, inflation's up a little bit of wage stability, I'm going to hike significantly, when the rest of the world is not doing so. So that's really what's key, is go slow, go very slow.
Are you actually worried about deflation being imported from the rest of the world into the U.S., or is it something else that's concerning to you?
Well, remember, if the Chinese are forced to the wall and eventually have to devalue significantly, they do export deflation to the rest of the world. And so that would be very adverse for the globalization of trade, which is already meeting a lot of resistance. And so the last thing we need to do is tip the world over into some sort of a slowdown that's uncontrollable.
You set an S&P target of 2,100. Are you sticking with that? Are you thinking about adjusting that at all?
You know, we're a long way, at least on a domestic sense, from the sort of Fed-induced recession you would get. And we've done a lot of work on this that shows that's not really a risk this year. Maybe next year and the year after it'll be a bigger risk. So I think we go up before down. Over the next 4 to 5 years, the market will be roughly flat, but we're up before down, and our biggest risk, as I said, is policymaker error and the context of the global economy.
Just quickly here before we go, what are you making of what we're seeing in the oil market here? There was talk last week, of course, of seeing some light at the end of the tunnel from the IEA. What are you thinking about oil prices?
Yeah, some of the oversupply issues, such as U.S. shale production, has been slowing. Non-OPEC production has slowed down in general. OPEC production does look kind of maxed out. I'm not overly optimistic about Iran's ramp of production. And so if you get better demand, a little less supply, and the dollar's been topping, then that's why oil's been on a tear. But nothing's a straight line. You'd expect some volatility, and we're getting a little bit of a pullback in that trend.